Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AKA Hotel Residences Corman Communities, Ariel Property Advisors, Amerant Bank, Bank of America Merrill Lynch, Briarwood Organization, Chase Commercial Mortgage Lending, Chase Commercial Term Lending, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, Keysight Capital Partners, Matone Group, New Banks, Newmark Knight Frank, Ocean First Bank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, Stonehenge NYC, SVN CPEX Real Estate Services, Tierra CRG, the Meringer Family Foundation, and these friends.
Financing for real estate during a pandemic. Sounds interesting, but it's not that interesting, but it's really hard. So today I've assembled 3 individuals to provide their insight on financing for commercial real estate during this terrible pandemic. My guests include Chris Niederprun, Head of Real Estate Financing at CIT, Patrick Young, Vice President and Team Leader at M&T Bank, and last but not least, Peter Meyer, Managing Director and Senior Mortgage Lending Officer at New York Community Bank. So we started the year off and everybody was a little busy reviewing the websites and the press releases. CIT was busy, M&T was busy, and needless to say, New York Community Bank was busy. Let's talk about what's in the pipeline and how busy you are today. Peter.
Yeah, right now, as I stated before, we're very busy. We are closing a lot of loans. The pipeline is actually quite full right now. We're in a good spot. We had very good momentum going in the second quarter and the third quarter. We expect that to continue in the fourth. But and again, the pipeline is nice and full, so we're very busy here. We're back in the office about 50% capacity, and that's helping us move along the loans.
So, prior to the taping, I spoke to Patrick, and Patrick was saying that he's doing loans with existing clients. Patrick, are you looking to do any loans with people who weren't existing clients today? Or would you prefer to stay with clients only?
Well, I think you've heard this consistently from my M&T colleagues over the years, Michael, but for us, it always comes right down to sponsorship. It's always going to be the distinguishing factor for us when we're underwriting new or evaluating, new deals. And that's irrespective of where we are in an economic cycle, and it transcends, individual deal characteristics and asset classes. But, it's not to say we aren't doing new deals for new clients. We're certainly focusing on supporting and rewarding our existing relationships, but under the right circumstances for the right deal and for the right sponsorship, we would certainly consider doing new deals for new customers. And it may come with, additional structure, additional credit enhancement, different recourse structures and economics, and certainly we're part of the conversation prior to COVID. But under the right circumstances, we would, and it would certainly come with, an ability to expand the opportunity beyond just credit opportunities with that client. But we would certainly consider it right now.
Chris, with regard to the transactions, because you're on a national scale, more on the national scale, in our region, what type of loans have you been pursuing on? Or what do you have in the pipeline? What type of transactions?
You're right, Michael. Our platform is national in scope, right? We focus on, we're certainly more heavily focused on the Northeast and Southern California, which is where we have our kind of primary offices. We also have a branch network, a retail branch network in Southern California. That said, we've expanded our platform over the years, and we're kind of in the top 35 MSAs around the country. And so irrespective of which market we're in, our financing these days is really focused around narrowed down to kind of multifamily and the industrial or warehouse space. Those are kind of the two asset classes that we think right now we feel comfortable underwriting. Very difficult to underwrite office. It's very challenging to understand what the long-term future of office use holds. And then we don't, I don't have to get into the challenges that the hospitality and retail sector are facing. So those, from a bank perspective, are very difficult to underwrite. So we've continued to lend through this pandemic. We're lending, Patrick, the key word is sponsorship, always has been for CIT as well. So we focus on, well-capitalized sponsors, low loan to cost, a lot of equity in transactions. And we're doing that primarily around multifamily and industrial space.
Peter, New York Community Bank is regional, but you also have locations. You have the Cleveland operation, the Arizona operation, and the Miami and the Florida operation. What are you doing around the country with regard to financing?
Well, a lot of those areas, we've always focused on multifamily down there, out in those areas. So we're continuing focusing on there. We're still getting a nice flow of business from those areas. The Miami area right now, a little bit of a challenge, but we are actually refinancing a couple of our office buildings down there where we're confident. Again, it relies on the sponsorship. Some of these loans we've had on our books for many years. Either we're extending the rate out another 5 years or, cash out a couple of dollars extra in their pockets. But everything we've been producing all over, and it's actually been pretty amazing. It's a tribute to our team here in the house that we can still continue to do this.
Chris brought up the term before when he mentioned hospitality, it was like a pause, okay? So hospitality and retail are businesses that are difficult. When you see a deal today, let's say a multifamily or even, a mixed use situation, how are you taking into consideration the retail risk? Are you underwriting? Are you valuing any of the retail? Are you taking reserves? How do you look at it for that? Chris, you first.
Sure. Yeah, we're looking at a mixed use project that has some retail. We want it to be a relatively small percentage of the income and therefore the value. And depending on the type of retail that it is and the market, we're going to discount how much we value that in the underwriting much more today than we would have in the past. And we want to be able to rely primarily on the other component, the multifamily component. So and that's kind of always been the case, but certainly more so now, Michael. It's again, hotel and retail are very difficult to underwrite and get behind these days.
Peter, I know that certain people who are competitors, there are really no few competitors except for the three guys over here of New York Community Bank with regard to retail. Specifically Chase, when they're currently doing any of their multifamily, they're taking no credit for the retail. How are you looking at the retail today in the mixed use buildings, the multifamily buildings that you have?
Well, we're still doing some retail in the mixed use buildings. In our underwriting, we're taking a bit of a heavy vacancy. We're looking at collection reports several times throughout our due diligence period. We're also doing a couple of deals we had last week. We actually called the retail tenants, asked them what their plan was, not, are they open? What are they doing? How's business? We just kind of called not as a bank, but just to get some general information. We're looking at, again, the tenant estoppels are very important right now. And we are looking at the collection and arrears reports prior to presenting to committee. And again, we're looking at them again, a couple of days prior to closing. If we need additional credit enhancements, we are doing that also.
Patrick, M&T Bank has significant retail exposure and hospitality exposure around the country and over here, but they were great loans. How are you looking at retail today?
Yeah, so we actually just closed a retail deal last week, and it came down to being a best-in-class client of ours and to sponsorship again. But, in terms of underwriting new deals that have any sort of reliance on retail or commercial income, we're certainly marking, rents down to prevailing market rents. We're likely sensitizing them from there. We're adding and folding in additional credit enhancements and recourse structures that were not likely to be part of the conversation prior to COVID. But we're looking at we're parsing through and looking at tenant rosters and looking at the profile of tenants, and we're thinking about the tenants that are holding up in pandemic situations right now, like neighborhood service retailers that can remain open, have not been subject to state mandated closures. We're really still distilling it down to doing deals for the right sponsors and at the right bases. We like, as Chris alluded to, more equity in these deals, more proverbial skin in the game to protect for these owners and developers. But we're still doing the transactions. It's definitely a different conversation than prior to COVID.
In my many conversations with individuals, leasing brokers, specific retail leasing brokers, most of the restaurants today are going on percentage rents. Okay, in the past, in your underwriting, Chris and Peter and Patrick, you didn't look at percentage rents because there were no minimums. How do you look at underwriting today with a percentage rent for the retailer who may be a restaurant out there?
It's difficult, right? It's difficult, Michael. We haven't. I have to say, I can't say that we've done much of that for that exact reason. It's very challenging. How do you underwrite revenue that's that there's no guarantee behind it. There's no obligation. So it's very challenging. I mean, Peter made a point earlier about a heightened focus on collections. I would second that. I mean, you're looking at collection reports. Call it a 90-day kind of diligence process. If your typical process you're going through, from your credit meetings through diligence to closing, and in the past you might pull the receivable report once, during that diligence process. And now you're looking multiple times, each month you want to make sure that collections have stayed solid. And so, and as Patrick alluded to earlier, I mean, you're really pushed to kind of ask yourself if you can underwrite, any type of growth in rents right now, right? In much of this space. So.
Recently, I did an analysis of certain of the banks in the region, and I noticed that a couple of banks are continuing to do new construction loans. So if someone came to you, who may be a good client or in a different manner, Peter, Chris, and Patrick, are you still entertaining new construction loans? Because existing construction loans, the projects may not be done for another year or 2 years, but I'm talking about new construction loans. Peter?
Well, we were never a big player in the construction. When we have done them, and we do have a lot on the books, it was always for existing people that we know and love. We will continue that. We have started 2 new construction loans during this pandemic, but they're guys that we know, they have a lot of equity in projects. Instead of a typical 18-month, 24-month period, we might make the initial term out for another 30 months possibly. Some more credit enhancements, a little more tighter on the draws. But again, we were never that big into construction, but what we do have in the books, what we always have, has always been with existing borrowers, and that we'd send out a quote on a deal that we're comfortable with.
A number of people today are talking about people relocating to the suburbs. Chris, you're up in Rye. So, there's a lot of new construction in New Rochelle, Stamford, and other areas. And I know that, Chris, you recently did a loan up there. How are you looking at the suburbs for, you know, because of this, you know, it could be like the 9/11 phenomena. People decided to leave the city during that period of time. You know, people are going to, New York City is going to rebound. But how are you looking at the suburban office buildings and the suburban residential projects? Anyone who wants to take that, Chris?
Sure. Yeah, I'm in Rye, and in my defense, we were here for 3 years, so I didn't jump on the exit New York. I'm still a believer in New York. Personally, still a believer in New York long term. So, yeah, we've done some lending in Westchester and Connecticut, and I would say that in terms of office, again, I think that space is still a bit murky what the future is, right? I mean, you hear statistics. So office users will need, 10, 15, 20%, space long term, right? And then they'll probably also shift that remaining 80% and use it differently. Some CBD, some suburban. We've certainly seen activity in the suburban office space. We've looked at some. I can't say that we've made any loans on suburban office, not for any other reason than we just, haven't found opportunities that fit our, kind of risk return profile. And in terms of multifamily, I think, we're looking at it, we're not looking at it with an eye that there's going to be a huge permanent, rush out of this city. I do think that there's, these are apartment buildings or they're short-term leases, so that they could ebb and flow and people could turn around and go back into urban areas. So, the lending we've done in the suburban markets has been where the historical, fundamentals support the project that we're doing. So that's how we've operated thus far.
Patrick and Peter, on the suburban market?
Yeah, we've always we've done a real lot of New Jersey suburban multifamilies lately, and we're still very strong on it. Collections are very good in the suburban Jersey market. Suburban office, we were never that big of a player, but we have refinanced some of our own stuff. We've, minimal cash outs, reserves, maybe some credit enhancements. But again, it goes down, we're a big sponsorship lender, relationship lender, and it's really, who these people are, how long we've known them, how they've reacted in the past. A lot of our borrowers go back to, the last downturn, and they were all very good to us and we were very good to them. So we have a lot of confidence in those guys.
During this pandemic, people should be rewarded for the risk reward situation. Have you adjusted your pricing to take into consideration the risk reward and taking additional reserves up front? That's part of my question. I mean, you have a higher reserve, maybe tenants aren't going to pay. You don't know about the office tenants. You don't know about the retail tenants. So when you're underwriting a new loan, maybe in the past you took in certain reserves for taxes and interest. Today, if you do a loan, are you asking for 3 to 6 months interest up front? Are you asking for reserve for principal? How are you underwriting the deals with regard to pricing?
Yeah. Oh, yeah. I'm sorry. We're taking what we're calling a COVID reserve, typically 6 or 12 months worth of P&I payments, giving the borrowers a choice. Be a 6-month reserve where they can't touch it. We'll release it once they can show us 6 months of satisfactory collections. Or they could take a 12-month reserve where we would pay ourselves out of that escrow account. And that P&I account for the 12-month would include tax escrows. So we are doing that. And again, it's pretty much up to the borrowers. In our underwriting, we've increased some vacancies and some miscellaneous expenses. We've always been a cash flow lender. So whatever your cash flow is today, that's what we're lending on. And then we're just protecting ourselves a little bit more with the different COVID reserves we use.
Chris?
Yeah, no, I agree with Peter. I mean, look, we focus on cash flow. We always have focused on in-place cash flow and the predictability of that cash flow. In this environment, and at times we take reserves if there's kind of the business plan it creates some movement in that cash flow. We've certainly for certain transactions taken larger reserves post-COVID than we would have pre-COVID. But I can't say that we're doing it every deal, and we're really focused again on what's the cash flow and is it predictable. And if we don't think it is, then it's probably not a loan we're going to make, reserve or not. In terms of, I think you were asking, in terms of pricing, but what I've seen in the market is, in April, pricing gapped way out, right? So maybe 150 basis points or something like that, depending if there was financing available. I think there was a period of time where it was gapped out, and you've that's probably come back in. You're probably 50 to 75 basis points, wider than pre-COVID. That's what I'm kind of seeing around the market. Again, depends, asset classes. I think, for hotels, I'm sure it's much wider than that. We're not entertaining hotel opportunities, so I couldn't tell you, but I'm sure cap rates have gapped out there as well.
I would agree, Chris. I think 50 to 75 bips of widening is about right. It's about what we're seeing in the marketplace. And with regard to reserves and certainty of cash flow and lack thereof right now, we're certainly solving for that more so with either reserves or credit enhancements, additional recourse, rather than solving for that with additional pricing. So I think it comes back to the core tenets of sponsorship and doing the right deals, rather than feeling like you can pick that up via increased pricing.
Okay, with regard to the office building market over there, many of the buildings in New York especially had 43 million square feet of space for co-working space. How are you looking at the co-working position, with the WeWorks, all of you? Patrick, I know you had some exposure on the co-working.
Yeah, we do. We have some exposure to co-working, and that's it's more limited at this point. It's again back to with the sponsorship group that we're underwriting more so than WeWork or the co-working space. Obviously, co-working was difficult to underwrite and assess long term prior to COVID. And during a pandemic, it's even more difficult with everything going on. So it continues to not be the optimal user for office space for us when we're underwriting. But I would say we would underwrite it in the same way that it's a fallback to sponsorship. It's a fallback to what are replacement rents, and is that achievable at the rent that this particular co-worker group is paying right now. But that being said, with everything going on in the market, who's to say what is reasonable replacement rents right now? So I would say co-working was challenging prior, and it's now more so with COVID-19.
Here's a question with regard to industrial and speculative. There are a number of industrial buildings in various stages of development or plan. Since e-commerce is having such an effect on the brick and mortar retail, are you looking at the industrial, which may not even have a tenant in the space? Chris, Peter?
Yeah, well, we will look at speculative industrial development. We'll look at it with a very focused eye, right? But I think that there are certain markets or sub-markets around the country where there's been historically been very strong for the kind of industrial or distribution space. They've continued to be strong in recent years and through the pandemic. We've all seen the rise in numbers, percentage of how much retail is purchased online versus bricks and mortar. So if we would entertain that. It's going to be the things that we look at are loan to cost, so equity. It's going to be a very low loan to cost, and it's probably going to be a relatively small square footage type of property. We're not going to there's the 1 million, 2 million square foot distribution centers is not for us, but we'll look at it very 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 cautiously. And for the right, we go back to for the right sponsorship, probably existing client. Folks that have performed and we feel comfortable with.
One last question before we finalize. The topic of hospitality. Are anybody looking to do any new hospitality? I know you may have existing hospitality, but what about new hospitality?
Not here, not at CIT, not in this business. It's not an asset class that we feel comfortable with. we never did a lot of it, candidly, even pre-pandemic. And given the pressure on the sector, we've really stepped away from that. I think as bank lenders, the risk return is just not there. So not a space for us.
Pete?
Yeah, that was similar. We were never a big player in the hospitality market, but just because of the ebbs and flows of the cash flows of those assets, it's not something we always looked at. And, I don't see us doing that in the future. We haven't really done it pre-pandemic. It's just not the type of property that we're comfortable with.
Patrick?
My friend Brennan Keating, Michael, that runs the hospitality lending for us out of New York. He would be able to speak better to that than I, but I know we're not certainly looking for new hotel loans. That was something that we always did with a even more scrupulous focus on sponsorship there. And I know that still remains the case, and they're working with our group of existing borrowers, but no, it's a tough asset class right now to finance for sure.
Okay, so in summation, I think we can identify the following: sponsorship, equity, loan to cost, and who we're dealing with. And I think 2021, all of the people sitting over here are going to be lending. You're in the lending business. There is financing for the pandemic. Hopefully things will get better when the vaccine is come. I'd like to thank Chris, Patrick, and Peter, and I'll see you next week.
Thank you,
Thank you,
guys.
Michael.
Have a good
Thank
day.
you very much.